markets at ICICI Bank as well to talk about which way the bond markets and money markets could head in these globally turmoiled times. Prasanna, good to have you on the show. Firstly, let's go back a little bit, and after the policy, we've seen the one-year bond yield declining, whereas the longer duration increasing, hence leading to an increase in spread between the short and the long-term yield curve. How do you see this phenomena, and where do you think it's going to be headed next?
Yeah, so I think what really happened in the RBI policy was a little bit of a surprise to the markets. You got a couple of positive surprises in the form of a 50 bp rate cut instead of a 25, and you got a CRR cut, which was not expected. But on the other hand, you also had a hawkish surprise, which is the change in stance from withdrawal from easy accommodative policy to a neutral stance, which was not again expected by the market. So what it led to on that day and in the subsequent days is repricing of the interest rate trajectory. Like what people or what the markets were expecting was for the repo rate to be cut to 575 and then to 5.5 in August, and maybe people were even willing to look at 5/4 or some people even 5% as a terminal repo rate. By virtue of RBI changing the stance and also by virtue of the fact that they very clearly said there is very limited space for monetary policy to be accommodative anymore, it kind of led to repricing of rate expectations in the market. And typically when rate expectations change, typically you see the long end reacting first. So you saw anything upwards of 5-year, whether it's a 7-year, 10-year, and the 30-year bond yields going up. But the short end didn't really react on Friday when the policy happened, primarily on account of the liquidity surfeit which is available. But then post that, we have also seen the short end yields also going up because RBI also the governor didn't make a very positive comment that VRRR auctions will not be made. In fact, he said that they will be sitting and deciding whether to suck out liquidity using VRRR at the extreme short end. So that had led to some kind of a reaction, negative reaction on the short end as well. So all in all, you had a very positive policy, but you had a typical bond market reaction, which was negative across the curve. And I maintain that this policy is a policy for the real economy where the benefits are going to be served by the borrowers and the lenders directly because of the fall in EMIs and fall in deposit rates.
All right, but Prasanna, with the yield curve steepening, do you expect the bondholders moving to shorter duration bond as the long duration bonds may underperform a steepening yield curve?
So right now, I think the market is possibly overinvested in bonds, and people are trying to figure out what is the right level of bonds, considering the fact that the stance change has happened. So we saw a little bit of a shift in sentiment, and people are exiting bonds, whether it was short or long or medium term. But you're right, over a medium term, I think beyond the next 3, 4, 5 days, once stability comes in, once bond markets and interest rates settle at a new equilibrium, based on what people think is going to happen going forward, because bear in mind also that inflation came lower and the US also is looking like possibly cutting rates this year. So maybe the terminal repo rate can actually head towards 5/4 if data were to support. So there is going to be a new equilibrium which is going to be formed in the market over the next, say, 5 to 7 days. And when that happens, I do think what you're saying will happen, which is net between pre-policy and now we will see a steepening of the yield curve. We see people getting back into the short end of the curve, maybe up to 5 years, 7 years, and 10-year might be neutral, whereas the long end might not behave as well. So I think that's where we are as far as the interest rate curve is concerned.
Mr. Prasanna, I also want to talk to you about Indian bonds in the backdrop of US bonds, because the yield gap between India 10-year and US 10-year Treasury bond has declined to 1.8 from 2.2 thereabouts in the start of this calendar year. How do you see this, especially in terms of flows now into Indian bonds?
So there are two things. The second thing is what's happening to flows. And the first thing is, can Indian bond yields sustain this trend where the differential is really narrowing? I think what needs to be kept in mind is the kind of positivity that is there in the Indian macro at this point of time. where even with a widening current account deficit, it is still less than 1% of GDP. There used to be times when it was 4 or 5% of GDP. Then you have the services and the remittances really doing well to support a widening trade deficit. And you have a balance of payment which is broadly at balance, even though FDI inflows are net FDI inflows are not coming in as much. So usually when the interest rate differential narrows down a lot, especially between the Fed rate and the RBI repo rate, you can see that if the current account deficit is poor, then there is a run on the currency by virtue of outflows and all that. We are seeing none of that happening primarily because of the excellent macros like I spoke about. And hence looks like this time it is different, and hence it can sustain a narrow interest rate differential. Now, to the second question of what's happening to the flows, that's a valid question because international investors who are looking to invest into various countries and doing allocations, the active investors still have a choice. They can choose not to invest in a country which has depreciating currency and a very, very narrow interest rate differential. So they might not come in, but there will be passive investors who are tracking the index in which India is now a part of and likely to become a part of a few more indices as we go forward. I think those AUMs will have to come into India and will come into India over the period of next few months. But if you're talking about active bond flow investors, I think it is a little difficult to attract flows with interest rate differential being so narrow. But also bear in mind that something else which is happening, which is favoring India, is the fact that there is a medium-term dollar weakness story, which is now coming up in the last couple of months, because of which the international investors have now figured out that there is no country in which they can invest without any true currency risk. In the past, it used to be the US, where people invested from across geographies into the US and then did not hedge the currency, the US dollar. But right now, it looks like the dollar index is in a weakening trend from a weakening perspective. So that part is actually helping the INR and actually helping money coming into India. So at some point of time in the future, we can get back those flows.
Sure. What about the FAR bonds though? Because they've seen big selling in the first quarter of the fiscal. What's leading to this and what are your expectations going forward?
Sorry, I didn't get you. What was the question? Which bonds?
FAR?
Okay, yeah, that's where the interest rate differential comes into play. And to some extent, I think the narrow interest rate differential is what has led to some outflow. But like I said, I think it does discourage, but index flows will come in. The passive flows, that is, the active investors might take a little bit more to come. We need to find a equilibrium for us to first settle here, because what has also affected us here is the fact that the RBI's interest rate stance has changed, and so everybody is trying to figure out what is the right level, where is the repo going to settle in this cycle, what is the right level of how long will it stay at that level, and what is the right level of term premium between the 1 year and the 10 year and so on and so forth. So difficult to give a very clear answer at this point of time, but over a period of time, I think we will get some solace in terms of inflows.
All right, Prasanna, with this, we let you go on that. Thank you so much for taking the time out and speaking with us and giving us a sense what's really panning out when it comes to the bond market and the implications of the rate cut, how they will impact the overall bond market as well. But moving on, let's put the spotlight on